In this lecture, we will discuss budget variances. Firms compare their actual costs for a given period with the costs that they budgeted at the beginning of that period. This is important for two reasons. First, budgeting is very important for the efficient running of a firm. By comparing actual results to budgeted results, a firm can evaluate its budgeting process and try to figure out how to improve that process. Second, calculating budget variances is an important tool used in evaluating the job performance of different employees. In the lecture on budgeting, we concentrated on creating a budget assuming one level of activity. This is called a static budget. The problem with static budgets is that the assumed level of activity may not be the actual level of activity. When that is the case, a comparison between budgeted variable costs and actual variable costs becomes problematic. The budgeted would cost to make 20 baseball bats should be more than the actual would cost to make 15 ball bats. So, comparing these actual and budgeted costs doesn't tell you anything. You want to compare the actual would cost to make 15 baseball bats with the budgeted cost to make 15 baseball bats. For variable costs, the budgeted and actual costs have to be based on the same level of activity. For example, assume that a firm's budgeted direct labor cost of $100,000 is based on the assumption that the firm will produce 10,000 units. Also assume that the firm's actual labor cost of $90,000 resulted from the firm producing 9,000 units. While it is true that the firm's actual costs are $10,000 lower than the budgeted costs, it is also true that the firm actually spent $10 per unit, which is what was assumed in the budget. In order for the comparison of the actual and budgeted costs contained in the budget variance to mean anything, the budgeted and the actual costs have to be based on the same level of activity. This isn't a problem for fixed costs, because you don't expect a fixed cost to change because you had a different number of units produced. For variable costs, however, the costs are supposed to change when the units change, and the budget should change as well. For variable costs, we use flexible budgets. Completely flexible budgets are cost functions. Tell me how many units your firm produced, and I will plug that number into the cost function and tell you what your budgeted cost for that many units should be. For example, if your cost function is $30 per unit times the number of units that your firm produced, then you can say that the budget for 10 units is $300. When you use flexible budgets to calculate budget variances, you now have a meaningful comparison between budgeted and actual costs because both the budget and the actual costs reflect the same activity level. We will now discuss price and quantity variances. There are two reasons why a firm might go over or under budget. Imagine that you are making t-shirts for your club to sell to raise money. You budgeted the cost of the cloth to make those t-shirts at $1,000 and you spent $1,100. Why did you go over budget? One reason might be that you thought you were going to use 1,000 square yards costing $1 per square yard, and you paid $1.10 for your 1,000 square yards. Another reason might be that you did spend $1 a square yard for your materials, but you used 1,100 square yards of materials instead of 1,000 square yards. Therefore, a budget variance can be due to price and/or quantity. Knowing whether your budget variance is due to price or quantity is very important because it tells you who you should talk to about the variance. If the variance is due to price, you want to talk to the person who bought the materials. If the variance is due to quantity, you want to talk to the person who did the cutting and sewing of the t-shirts. Knowing these variances is very important for a firm when evaluating the job performance of its employees. A budget variance is the difference between the actual and budgeted cost for a cost component. We will calculate budget variances for direct materials, direct labor, variable overhead and fixed overhead. Each of those budget variances will be subdivided into two variances. For the variable costs, These two variances will subdivide the total variance into the portion of the budget variance due to the price reason that we discussed and the portion due to the quantity reason. We will now discuss standard prices and standard quantities. Standard is a synonym for budget. The standard price is the budgeted price that your firm thinks that it will spend on a unit of the cost component. For example, the standard price for direct labor could be $10 per direct labor hour. This is the unit of the cost component, not the unit of the product itself. If it takes 3 direct labor hours to make a shirt, the standard price is $10 per direct labor hour, not $30 per shirt. The standard quantity is the amount of a cost component that your firm thinks that it will take to make one unit. For example, your firm may budget that it takes 3 direct labor hours to make one computer. That would make 3 direct labor hours the standard quantity for one unit. When you see the standard quantity in the columns that we use to calculate budget variances, the standard quantity means the quantity that our firm budgets to make the amount of units that the firm actually makes. This is still a budget number, but it is a flexible budget that is linked to the actual activity level rather than a static budget. For example, if your firm made 1,000 computers, the standard quantity would be 3 direct labor hours times 1,000 computers, or 3,000 direct labor hours. In order to calculate budget variances, you need information on the actual price and quantity of a cost component. For example, although you budgeted that your firm would pay $10 per hour for direct labor, your firm actually paid $11 per direct labor hour. This is the actual price. Similarly, although you budgeted that your firm would need 3,000 direct labor hours to make 1,000 computers, your firm actually used 3,300 direct labor hours. This is the actual quantity. When calculating budget variances, you set up 2 columns to represent the actual cost and flexible budget for a given cost component. The actual cost is the actual price times the actual quantity. The flexible budget is the standard price times the standard quantity to make what your firm made. The difference between these 2 columns is the budget variance for the cost component in question. As we said earlier, we want to subdivide the total budget variance of a variable cost component into its price and quantity variances. In order to subdivide a total budget variance into the portion of the variance due to price and the portion of the variance due to quantity, we will now introduce a middle column, which consists of the standard price times the actual quantity. When you subtract the middle column from the left column, you are calculating actual price times actual quantity minus standard price times actual quantity. When you factor out the common actual quantity, you get actual quantity times actual price minus standard price. Because you are comparing the actual price and the standard price, this subtraction gives you the price variance. Some cost accounting books do not like to teach the column approach that we are using. Instead, they use formulas to calculate the variances. This is the formula for the price variance. When you subtract the right column from the middle column, you are calculating standard price times actual quantity minus standard price times standard quantity. When you factor out the common standard price, you get standard price times actual quantity minus standard quantity. Because you are comparing the actual quantity and the standard quantity, this subtraction gives you the quantity variance. This is the formula for the quantity variance. Notice that you are always subtracting the standard from the actual. If you are over budget, then the actual will be greater than the standard and the subtraction will give you a positive number. Thus, whenever the variance is positive, it means that you are over budget. When you are over budget, the variance is referred to as an unfavorable variance. When you are under budget, then the actual will be lower than the standard, and the subtraction will give you a negative number. Thus, a negative number means that you are under budget, and the variance is referred to as favorable. A favorable budget variance is given as a positive number despite the calculation produces a negative number, and it is noted that the variance is favorable. Let us do an example. Assume your firm makes 1,000 shirts, and that you estimate that your firm will pay $2 per square yard for direct materials. This is the standard price. Also assume that you estimate that you will need 3 square yards of material to make one shirt. This is the standard quantity for one shirt, and the standard quantity for the 1,000 shirts that your firm made is 3,000 square yards of materials. Your firm budgets that it should take $6,000 to make the 1,000 shirts that it made. The actual direct materials cost your firm $5,880. The standard price paid was $2.10 per square yard, and your firm used 2,800 square yards of materials to make the 1,000 shirts. When you plug the actual and standard prices and quantities into the columns, you see that the actual cost to make the 1,000 shirts is the total of the left column. You also see that the flexible budget to make the 1,000 shirts is the total of the right column. The middle column totals $5,600. When you subtract the middle column from the left column, you get a positive $280, which gives you the material price variance of $280 unfavorable. When you subtract the right column from the middle column, you get a negative $400, which tells you that the materials quantity variance is $400 favorable. When you add these two numbers together, you get a negative $120, which tells you that your firm has a favorable total materials budget variance of $120. This setup and these calculations are generally the same for all of the variable costs. The names of the variances used by different cost accounting books can be different, but the calculations are the same. For example, the material quantity variance can also be called the materials usage variance or efficiency variance. The labor price variance is often called the labor rate variance, and the labor quantity variance is often called the labor efficiency variance. The variable overhead price variance is often called the variable overhead spending variance, and the variable overhead quantity variance is often called the variable overhead efficiency variance. There is a special rule for the material price variance. In our previous discussion, we have assumed that our firm purchased the same amount of materials that it used. What if the firm purchased a different amount of materials than was used in making its products? When the problem specifies different amounts purchased and used in production, then the amount purchased is the actual quantity used when calculating the material price variance. The actual quantity used remains the actual quantity when calculating the material quantity variance. Let us go back to our previous example and assume that the firm purchased 5,000 square yards of materials and used 2,800 square yards of materials to make 1,000 shirts. The calculations for the materials quantity variance remains unchanged. It is still a $400 favorable variance calculated using 2,800 square yards of materials. However, the calculation of the material price variance has changed. Now the actual quantity is 5,000 square yards of materials in the left and middle columns. As you can see, you have two different middle columns. The column that you use depends on which variance you are calculating. The materials price variance is now $500 unfavorable. We will now discuss how to calculate the fixed overhead variances. The fixed overhead variances are calculated differently. Before we were dealing with variable costs. Now we are dealing with a fixed cost. With variable costs, your estimated costs should change depending on the level of your firm's activity. With fixed costs, however, your firm's estimated costs should not change just because you are making more or less units than you anticipated. For this reason, the budget variances should compare actual costs to the static budget for fixed costs rather than the flexible budget. For example, assume that your firm calculated its predetermined fixed overhead rate, assuming that its fixed overhead is $100,000 and that it will make 10,000 units taking 1 direct labor hour per unit. So, its estimated driver is 10,000 direct labor hours, and its fixed overhead application rate is $10 per direct labor hour. Assume that the company made 9,000 units. The fixed overhead flexible budget for 9,000 units is $10 times 9,000 units times 1 direct labor hour per unit. The flexible budget is therefore $90,000. If your firm actually spent $95,000 on fixed overhead, it looks like your firm went over budget by $5,000. But your firm's fixed overhead budget was $100,000, and your firm is really $5,000 under budget. Using the flexible budget for fixed costs is wrong. You need to use the static budget. We will leave the right-hand column alone, but we need to make an adjustment to introduce the static fixed overhead budget into our calculations. This is the second time that we depart from our standard 3-column setup. Here we will replace the middle column with the static fixed overhead budget. This will create two variances, the fixed overhead spending variance and the volume variance. The spending variance is the real fixed overhead budget variance. It compares the actual cost with the static fixed overhead budget. The volume variance only exists because the actual volume of units assumed by your firm when it calculated its fixed overhead application rate, which was 10,000 units, is different from the actual number of units produced, which was 9,000 units. That is why this variance is called the volume variance. A problem may not expressly give you the static fixed overhead budget. Instead, it may give you enough information for you to figure out the static fixed overhead budget amount. In order to do this, you need to remember that the standard price is the predetermined fixed overhead application rate. It was calculated by dividing the estimated fixed overhead by the estimated driver. You should remember the formula that you use to calculate the predetermined fixed overhead rate and plug in the information that you have been given. Then you should solve for the amount of the estimated fixed overhead. For example, if you were given that the standard price for fixed overhead is $10 per direct labor hour and that 10,000 direct labor hours were assumed when the predetermined fixed overhead application rate was calculated, then you know that if you multiply 10,000 direct labor hours by $10, then you will get the amount of fixed overhead that was estimated, which is $100,000. The amount of the estimated driver is often called the normal capacity. Let us do an example. Assume that the standard price for fixed overhead is given as $10 per direct labor hour. Assume that the normal capacity is given as 10,000 direct labor hours. Also assume that the actual fixed overhead is given as $110,000. The standard quantity for 1 unit is given as 5 direct labor hours and your firm made 2,500 units. The fixed overhead budget was not given, but you can calculate it. The standard price of $10 per direct labor hour was calculated by dividing the fixed overhead budget by 10,000 direct labor hours. Thus, if we multiply $10 per direct labor hour times 10,000 direct labor hours, we can derive that the fixed overhead budget was $100,000. Now we set up our 3 columns with the actual fixed overhead costs of $110,000 in the left column, the fixed overhead static budget of $100,000 in the middle column and the flexible fixed overhead budget of the standard price of $10 times the standard quantity of 12,500 direct labor hours, which was calculated by multiplying 5 direct labor hours times 2,500 units. This gives you an unfavorable fixed overhead spending variance of $10,000 and a favorable fixed overhead volume variance of $25,000. The end.